Hello everyone, and welcome to this definitive explainer on IND AS 20. As a seasoned auditor, I literally spend my life looking through the fine print. So today, we are meticulously unpacking the Indian Accounting Standard 20, Accounting for Government Grants. We'll go through this with an auditor's eye, keeping a nice, steady pace to make absolutely sure you know exactly how to treat these benefits on your books.
Ever wondered how to account for that massive government subsidy without failing your next audit? Well, you're in the right place. In this explainer, I promise you we're covering 100% of the standard. We're leaving absolutely no paragraph behind. We're going to look at exactly what qualifies as a grant, how to recognize it, and precisely how to present it to ensure complete compliance. Okay, let's dive right into our auditor's master checklist. Our agenda today covers 5 logical steps: scope and definitions, recognizing grants, presenting grants, repayments and assistance, and finally, disclosures and dependencies.
Section 1, Scope and Definitions. Setting the boundaries of IND AS 20.
Before we look at what's in, we absolutely must know what's out. This standard doesn't deal with the special problems of accounting for changing prices. It also strictly excludes government assistance provided as income tax benefits. Things like tax holidays, investment tax credits, or accelerated depreciation. Furthermore, if the government is participating in the ownership of your entity, that is completely out of scope. And finally, if you're dealing with grants related to agriculture, well, you'll need to jump over to IND AS 41 for that.
Now, this is where it gets really interesting. There's a distinct line separating general assistance from actual grants. Government assistance is just a broad action providing an economic benefit, but government grants, sometimes called subsidies or premiums, involve an actual transfer of resources. And here is the catch. They're given in return for past or future compliance with your operating activities. If the transaction just can't be distinguished from your normal trading, or if a value can't reasonably be placed upon it, it's simply not treated as a grant.
We also need to define a couple of special financing scenarios. First up, forgivable loans. These are loans where the government actually waives repayment under prescribed conditions. If you have reasonable assurance you'll meet those conditions, you treat this loan exactly like a government grant. Simple, right? Second, what if you get a government loan at a below-market interest rate? Well, the standard requires you to measure this loan under IND AS 109, the standard for financial instruments. The benefit, which is the difference between the initial carrying value and the actual proceeds received, is treated as your grant.
Section 2. Recognizing grants. The core principles of IND AS 20.
Here is the golden rule, folks. Mere receipt of a grant doesn't guarantee recognition. You absolutely need reasonable assurance of 2 things. First, that you're going to comply with the conditions, and second, that the grant will actually be received. Once recognized, related contingent liabilities just follow IND AS 37 for provisions. Now, if a grant is awarded for immediate financial support, or maybe to compensate for past expenses or losses with no future related costs, you must recognize it immediately in the profit or loss of the period it becomes receivable. Just make sure you include clear disclosure so its effect is properly understood.
And this brilliantly illustrates the big philosophical debate in accounting: the capital approach versus the income approach. The capital folks argue grants are just financing devices for the balance sheet, but IND AS 20 strictly mandates the income approach. Why? Because grants aren't just free money. They are earned through compliance. Therefore, they must be recognized in profit or loss on a systematic basis to exactly match the related costs they compensate.
Let's see how this matching principle applies in practice, because honestly, this is where so many companies fail their audits. If you receive a grant related to a depreciable asset, you recognize the grant in profit or loss over the same periods and in the exact same proportions as the depreciation expense on those assets. But what if the grant is for a non-depreciable asset, like a piece of land? Well, land doesn't depreciate. In this case, you match the grant to the periods that bear the cost of meeting your obligations. For example, if you're granted land on the condition that you erect a building on it, you'd recognize the grant in profit or loss over the life of that specific building.
Speaking of land, how do we actually value non-monetary grants? If the government transfers a non-monetary asset for your use, it's usual to assess the fair value of that asset under IND AS 113 for fair value measurement, and then account for both the grant and the asset at that fair value. However, the standard does offer a perfectly acceptable alternative. You can choose to record both the asset and the grant at a nominal amount.
Section 3. Presenting grants, assets versus income in financial statements.
When you have a grant related to an asset, IND AS 20 gives you 2 acceptable methods for presentation on your balance sheet. Method 1, you can set the grant up as deferred income and recognize it in profit or loss systematically over the asset's useful life. Or, method 2, you can deduct the grant directly in calculating the carrying amount of the asset, which means the grant is recognized in profit or loss as a reduced depreciation expense. But remember, as an auditor, I'm always going to check your statement of cash flows. Because the purchase of assets and the receipt of grants cause major cash movements, you absolutely must show the gross investment in your cash flows, regardless of which presentation method you chose for the balance sheet.
For grants related to income, you also have two acceptable choices. Method 1 is to present the grant as part of profit or loss, either separately or under a general heading like other income. Supporters of this approach say it avoids netting items and facilitates really easy comparison. Method 2 is to just deduct the grant and reporting the related expense. Supporters of this method argue that the expense might not have been incurred at all without the grant. The good news here, both methods are perfectly acceptable under the standard.
Section 4. Repayments and assistance, when things change, and unvalued benefits.
Now, what happens when conditions fail? As an auditor, this is exactly where I look. Let's examine the protocol for returning the money. Step 1. Treat this as a change in accounting estimate under IND AS 8. Step 2. For an income grant, apply the repayment against unamortized deferred credits first. Any remainder hits profit or loss. Step 3. For an asset grant, increase the carrying amount or reduce deferred income. And pay really close attention here. Any cumulative depreciation you would have recognized without the grant must immediately hit your profit or loss. And of course, always check for impairment.
Let's also quickly revisit government assistance that does not qualify as a grant. Remember, things like free technical or marketing advice, the provision of guarantees, or government procurement quotas that represent a portion of your sales. These either can't reasonably have a value placed upon them, or they just can't be distinguished from normal trading. Also excluded is the provision of general infrastructure, like an improved road network or a water supply for an entire local community. These are entirely excluded from grant accounting. Though if the benefit is highly significant, you absolutely must disclose its nature, extent, and duration so your financial statements aren't misleading.
Section 5. Disclosures and appendices, the paperwork and transitional rules.
Disclosure is all about transparency, right? Your financial statements must clearly disclose three main things. First, the accounting policy adopted for government grants, including exactly which methods of presentation you used. Second, the true nature and extent of the government grants recognized, along with an indication of other forms of government assistance you directly benefited from. And third, you must disclose any unfulfilled conditions and other contingencies hovering over the assistance you've recognized. Absolutely no hiding those pending obligations.
Let's quickly unpack the appendices to finish our paperwork. Appendix A clarifies that grants for operating in an underdeveloped region still fully meet the definition of a grant. Appendix B references IND AS 37 regarding levies. And finally, Appendix 1 notes the key differences from the international standard IAS 20. It points out terminology shifts, the lack of a separate income statement under IND AS 1, and it pushes the April 2018 transitional rules over to IND AS 101. To wrap up our masterclass, I want to leave you with this thought. The true test of financial transparency isn't just counting the cash you earned, but correctly accounting for the help you were given. Tracking conditions and applying the matching principle builds true financial integrity. Which begs the question, if we look really closely at your balance sheet today, are there any hidden government obligations you haven't properly recognized? Well, if you found this auditor's deep dive into IND AS 20 helpful, please like, share, and subscribe for more explainer content just like this. See you in the next explainer.